Dear Ben, very many thanks for your invitation and your kind introduction. Ladies and gentlemen, members of the panel, dear members of the audience, I welcome you all to our panel discussion on digital assets, the risks that they come with, and the opportunities that they create. Now, some of you will be aware that in March this year, the US president issued an executive order, and I quote, on ensuring responsible development of digital assets. The premise of the executive order is the dramatic growth in the market capitalization of digital assets. In November last year, non-state issued digital assets reached a combined market capitalization of $3 billion US dollars, up from approximately 14 billion in early November 2016. So from 14 billion to 3 trillion. Now this growth has profound implications for the protection of consumers, investors and businesses, including data privacy and security, financial stability and systemic risk, crime and national security, financial inclusion and equity, as well as energy demand and climate change. So we'll be discussing today digital assets and their impact on banking supervision, financial stability and public policy with a truly distinguished panel of experts with hands-on exposure to digital assets. I'll be introducing the members of the panel to you as we go along to avoid saturating you with information on their hitherto careers and contributions to public service, both in their countries of origin and beyond. Now, most of the panel members are lawyers by education and training, and all of them currently serve in positions of authority and responsibility around banking supervision and supervisory policy. I'm a lawyer myself, but not a supervisor, so I very much look forward to interacting with the members of the panel in the hope of learning more about the supervisory dimension of a topic that I am very passionate about and which, not unlike the US president, I consider to be important for the future of the world in which we live. A few words, if I may, on the definition of digital assets, which of course is central to our panel discussion today. You're no doubt aware that the concept of digital assets is notoriously difficult to pin down, which also explains the multitude of competing definitions and the substantial differences between those definitions. The focus of our discussion today will be on such things as cryptocurrencies and stablecoins, uncertificated financial assets only existing electronically in the form of tokens, such as, for instance, security tokens, non-financial asset type tokens, including utility, some payment tokens and NFTs, and finally, hybrid tokens. A few words also on how I propose to structure the discussion today. I will initiate our exchange with a first round of questions, one for each member of the panel. In the meantime, I would invite you to pose your questions. You, the members of the audience, please do so in writing through Hopin. I promise to try to pose as many of those questions as I can, possibly combining some of them where I detect common themes. Please don't be shy, do pose your questions. There should be enough time to answer as many of them as we can. We have 1 hour allocated to us, and let's try to make the best possible use out of it, acknowledging that we can only hope to scratch the surface of what is a very complex and very demanding topic. So, without further ado, let's jump right into it. My first question is to Mercedes Olano Libran, and before I come to it, a few words on her. Mercedes has served since 2019 as General Director of Supervision at the Banco de Espana, the central bank of the Kingdom of Spain. She originally joined the Banco de Espana in 1987 after obtaining a law degree from the Universidad Complutense de Madrid. At the Banco de Espana, she's worked as supervisor from 1991 to 2010, before taking on different management positions with various of the bank's supervisory departments. Dear Mercedes, welcome. Now, my first question to you is as follows. In a speech recently delivered to a symposium organized by the Observatorio de las Finanzas, the governor of the Banco de España, who also chairs the Basel Committee on Banking Supervision, painted a picture of the risks posed by digital assets. In his speech, he also touched in passing on the decentralized finance phenomenon, which in his words, and I quote, aims to replicate the dynamics of the provision of financial services, but in a decentralized and fully automated environment, removing the need for intermediaries. Now, my question to you is this. How do you, as supervisor, approach this phenomenon, and can you briefly walk us through the risks, but also any public interest benefits that you see in decentralized finance, both from the perspective of supervised banks and from that of financial markets at large? On to you, Mercedes.
Thank you very much, Phoebus, and thank you very much for the invitation to participate in this panel. Answering your question, for me is clear that the digital assets may be an opportunity for a lot of sectors in the economy, even for the financial sector. Most of the digital assets are using now to make payments more efficient, to drive innovation into the financial system, and also to enhance the financial inclusion, mainly in the emerging countries. They also are more suited to the modern society, in which the new generations, completely digital, obviously consider that the management of the financial business should be done through different channels than the traditional channels. Therefore, I consider that crypto assets are here to stay. But having said that, the approach of a supervisor to crypto assets should be at least a bit prudent. It's true that crypto assets, as I have said, provide for a lot of services to the modern society, but also pose a number of significant risks in consumer, financial institutions, regulators, and supervisors. In general, all of these risks derive from the specific characteristics of these crypto assets. In general, the platforms dealing with crypto assets are neither regulated nor supervised. Crypto assets are more volatile than traditional assets. The crypto assets transactions are negotiated in non-regulated markets, and also through bilateral non-standardized contracts. And there is a limited common understanding of the actual features and implications of these assets. Regarding financial institutions, I have said that there are a lot of risks for different participants in the financial transactions, but for the financial institutions, I am a supervisor. The risk that arise for dealing with crypto assets could be grouped in different categories. IT risk, as you have mentioned before, but market risk also, counterparty risk for the financial institutions, that can hold the crypto assets in their balance sheets. If the financial institution prefers to do an activity of intermediation or providing services to their customers. There are other kind of risks that could arise also. For example, legal or reputational risk as a result of mistakes in operation. And finally, as you have mentioned, the main risk or the main concern, really not exactly the main risk, but one of the main concerns for supervisors is that the different agents are using crypto assets or digital assets to do money laundering. Really, from a supervisory perspective, all of these risks should be identified first and then addressed in a coordinated manner and at a global scale. This is very challenging for supervisors, also because there is not a real legal framework that could support us. It's true that there are some regulatory initiatives underway. Let me mention in Europe, for example, regulation on markets in crypto assets, MiCA, and also all the efforts that the Basel Committee is doing in order to classify the crypto assets and also to establish a prudent treatment for them. But the implementation of the regulation for Europeans will last at least 2 years. And in these circumstances, for us, the supervisor, we are in the worst of the worlds, really. Namely, we have a business that is developing and extending exponentially, and we don't have any legal framework that could frame or support or supervise activities. This could generate a reputational risk for supervisors. Really, I think that we need to join forces to do our best to cross the desert until the legal framework is ready. And using, in the middle time, using or the current regulation in a stricter or unimaginative way, or issuing additional regulation, I call them a bridge regulation, in order to be able to address all of these risks. I'm a supervisor also. Expect that the institutions that are holding crypto assets or are intermediating in crypto assets should have a very strong risk management and risk measurement systems or frameworks in order to deal effectively with the new risks. And thank you very much.
Thank you very much, Mercedes. I now turn, if I may, to Professor Dr. Joachim Wuermeling, and a few words on him by way of introduction. Since November 2016, Professor Dr. Wuermeling has been a member of the executive board of the Deutsche Bundesbank, the central bank of the Federal Republic of Germany. His remit at the Bundesbank covers banking supervision, risk control, and information technology. His previous positions include serving as member of the European Parliament, State Secretary at the Federal Ministry for Economic Affairs and Technology, member of the Executive Board of the German Insurance Association, and Chairman of the Association of Sparda-Banken. Professor Dr. Wuermeling is a lawyer by education and training, and he has also held academic positions, as is obvious in his title. Professor Dr. Wuermeling, welcome, and thank you for being with us today. In a speech you delivered in May 2020 before the Association of German Banks, you identified asset tokenization as one of the major areas of change expected to affect banks. What was it that made you, as bank supervisor, home in on the asset tokenization phenomenon? has that phenomenon played out as you had expected it would in relation to banks? In other words, have many of them since become crypto asset service providers, or perhaps not? And do you see this phenomenon gaining in significance going forward? Thank you.
Well, thank you very much, Phoebus. Well, you gave in your introduction already the answer in mentioning the numbers of the increase of the market value of crypto assets in the last year. But as a central banker and supervisor, we see the changes which may be brought about by digital assets much more fundamental, because crypto assets may change the way how the financial system works entirely. Even the functioning of money, the features of money may be changed in a way by crypto assets. So for central bankers, it's fundamental to deal with to look at these phenomena, in particular when crypto assets aim to replace our own product, the public money, the euro in this case, by crypto assets. And that was also something you mentioned in your introduction, looking at metaverse or whatsoever. So even if 3 trillion of euro or dollar market capitalization, looking at the entire financial system, is not very much, it may be scaled by technological development or by adaptation very soon. And this feature of a very swift scalability may change the environment for payments, for trade, for other financial transactions. The way money works significantly in a short period of time. What makes the crypto assets so difficult for us as supervisors and also as central bankers is that these products fall completely out of the scope of the current legislation. A crypto wallet is not a bank. A crypto asset is not money. It is not a security, is not a liability. So we, in fact, have no grasp on these products until now, because our legislation doesn't cover them. Of course, we deal with some related issues, like how do we treat crypto assets when they are held by banks under the in terms of banking supervision. But the real issue, of course, is not here. The real issue is the product itself. Mercedes mentioned that regulation have started, the MiCA project, with also some legislation in Germany, which address the issues, but there are limits for our perimeter, because and the first is a geographical limit. These assets, they don't have issuers with a seat, so they are not really located anywhere. So jurisdictions may be helpless to regulate them. And the second thing is that they are global products and global services. So it's easy to circumvent a national jurisdiction. So I join very much the call from Mercedes that there should be global standards, but there are no global standard setters for these things yet. We have the standard setters for insurers, we have the standard setters for securities, for banks, but we have no standard setters yet for these kind of products. So here's a big, here I think is a big hole. But we also, of course, recognize that these new types of financial products can bring about a lot of benefits to the public. You mentioned the emerging markets, but there are also benefits for us because it's these tokens can make assets and products fungible and tradable worldwide, which have no deep markets in a specific jurisdiction. So the functioning of the financial system can be enhanced substantially. Also, financial stability can be enhanced. So the question in the title of our panel today, whether it's liability or opportunity, that's from my point of view not really the issue. The issue is we should try to place these products and infrastructures in the financial system, in the system of the economy, in a way that the benefits can unfold and the risks can be contained.
Thank you very much. I'm sure we'll have an opportunity to revert to some of the points you made later in the discussion. If I may, I'll now jump to Ondřej Kovařík. It's my pleasure to welcome Ondřej to the panel discussion today. A few words on Ondřej before I pose my question to him. His career has been dedicated to public service, both in his native country, the Czech Republic, and more broadly in Europe. He was elected a member of the European Parliament in 2019. Since taking up his position, he's chaired the Working Group for Access to Finance for SMEs. He has served on the Economic and Monetary Affairs Committee, where his focus has been the digitalization of the economy and digital finance. He has also been a substitute member of the European Parliament Special Committee on Taxation, where he has led the Parliament's work on several tax-related files, including elements of the new EU VAT regime. Ondřej, welcome. In September 2020, in your capacity as rapporteur for the European Parliament's Committee on Economic and Monetary Affairs, you published a report with recommendations to the Commission on digital finance. Now, in that report, you drew attention to the absence of a common EU regulatory approach to crypto assets and to the resulting risks in terms of market fragmentation, but also the resulting legal uncertainty and the opportunities for arbitrage that this situation creates. Now, less than 2 years ago down the line, the Commission has proposed a comprehensive digital finance strategy package, of which one major component, the MiCA regulation, is at the final stages of its adoption. So my question to you is this: are you satisfied with the pan-European regime for crypto assets that MiCA will signal once adopted? And if there is one element in MiCA that you could change, what would that element be? So on to you, Ondřej. Thank you.
Thank you. Thank you for the invitation, and thank you for your introduction. It's a big pleasure to be with you today and actually to discuss this very interesting and I think very dynamic issue of crypto assets and regulation of crypto assets. Indeed, when we discussed the Digital Finance Report in the European Parliament, we had in mind several, let's say, cornerstones of what could be the next steps on the European level. And I think the proposed market in crypto assets regulation, the MiCA, is actually one of them. And you're right. I mean, it's been a while since the Commission has proposed its initial draft. We are currently, let's say, in the final stage of negotiations, where we have the final mandate adopted by the European Parliament on one hand, and the common position of the member states on the other, and we are trying to merge them together in order to find a good compromise between those two positions, and to find would become eventually the final text of the regulation. I think when we look at the key challenges that we have identified with colleagues in the European Parliament, to many of them, the MiCA is actually a good reply. I think we see that there is actually a good point in having a harmonized EU approach in terms of regulation that would cover the entire EU single market, all the 27 member states, which would provide some clarity, let's say also predictability and stability to the business environment. And I think if we really start from the very basics of the regulation, in my view, the important point is that we, through the regulation, try to find definitions of various types of assets. We set definitions in terms of the key operators on the market. And on top of that, identifying various requirements, rights and obligations linked to those operators and also to these assets. And I think these are actually the very initial steps we need to cover in this area, because MiCA is actually entering in legal terms to uncharted territory. We have very robust financial services regulation in Europe, but we didn't have anything basically that would fully cover the area of crypto assets on the European level. And I think that is one important point to make. We have seen in the past years some of the national legislative framework to emerge, like the one in Germany, France. And I think that was a clear risk that if we don't move forward and fast enough on the European level, we may end up in a situation where different member states will go ahead with their own national legislation, which will cover their, let's say now, own national priorities, and we may end up in a very fragmented market in the end. And I think MiCA was able to MiCA was actually able to address that potential risk. In general, when we look at the priorities covered by the European Parliament, I think we managed quite well to introduce key principles and safeguards in order to guarantee the consumers and investors protection. As I mentioned, some key notions that are needed in legal terms. And I think also try to cover other areas which are linked to the specific nature of crypto assets. At the same time, we are developing and working on the updated AML framework, which should, together with MiCA, also address the potential risks and issues linked to the money laundering and terrorism financing in the area of crypto assets. To mention your last point, what would be one thing I could change to that regime? I think that's in my view, highly speculative question, because we are not at the end of negotiations yet. But I would say in general, the MiCA is, in my view, a very good proposal. I think the Commission did a very good job, and in terms of our work in the European Parliament, we didn't have to change too much. We added some of the issues. I think what I see as key priorities in terms of getting the framework right is to make sure that it's really principle based, it's forward looking, that it's innovation friendly, and I think we need to also look very carefully on the proportionality of the proposal. And in this regard, I see, for instance, some specific issues linked to the level of supervision or the entire supervision architecture to be set up by MiCA, to be scrutinized properly, and also not only when we speak about the supervision, but also when we set and request some of the let's say requirement or required actions from the business operators to make sure that these requirements are proportionate. I think it's different when we have a global acting crypto asset exchange, or if we have a locally based company that is issuing tokens for its own community. So I think that would be my two concerns I would point to in terms of getting the final outcome of the negotiations right.
Thank you very much, dear Ondřej. I now come to my final introductory question, which is to Kilvar Kessler. Since 2014, Kilvar has chaired the board of the Estonian Financial Supervision Authority. He was formerly a member of the board between 2002 and 2005, and then between 2008 and 2013. He has lectured in insurance and securities law at the Tallinn University of Technology and at the University of Tartu. And he's also practiced financial law, being a lawyer by education and training. Dear Kilvar, welcome, and thank you for being here with us today. My question to you is as follows. In April this year, you participated in the NFT Tallinn event. I find personally NFTs fascinating, also legally, and I'd be interested to hear your views as those of a supervisor and a lawyer on 3 points. First, considering that NFTs are non-fungible, do you consider them to qualify as securities under Estonian law? Second, my interpretation of the MiCA is that it does not encompass NFTs. Do you share that interpretation, and is it cause for concern that they would remain unregulated instruments going forward? And third, in your view, are NFTs within or outside the perimeter of EU anti-money laundering rules and regulations? On to you, Kilvar.
Thank you. I hope you can all hear me, and thank you for kind introduction, kind words, and quite heavy questions. So, but it's a pleasure to start answering these. As a financial supervisor, I think I have lost some of my lawyer qualities, but let's give a try here. Anyway, just prior to answering those three more or less technical questions, some context or background to our listeners and audience as well. I'm coming from Estonia, which has as a society quite a high level of digitalization, especially in the public sector. For example, the annual tax reports of citizens are pre-filled, and you can just check them and file them to tax board or IRS over the internet. Medical prescriptions are issued electronically. Everybody can access their own private health records online, like over the internet. I mean, you can change car ownership quite easily over the internet, make the changes to the register. So it's very convenient. We call it e-governance. And why I'm talking and why I'm referring to this e-governance, all this system operates on the basis of blockchain technology or distributed ledger technology. In the field of finance, I have heard occasionally that it's quite new technology. By the way, it's not true. I mean, our government was implementing this or starting to implement already at the beginning of this century. And the technology itself, the cryptography behind it, it's even earlier animal, so to say. And what comes to the risks, I think we were quite successful as a state, warding off the first ever recorded state-sponsored cyber attacks in 2007. When one state attacked our state systems. So it has also proven that it's quite safe technology-wise, the blockchain technology, and the kind of public services running on the basis of it. And why I'm talking about this, the context to understand, sometimes maybe I'm more relaxed to technology, sometimes I'm more cautious what comes to technology and the new financial features created on the basis of technologies, new in quotation marks, so to say. Well, now to the more technical questions on NFTs and other stuff. I mean, when we are qualifying something under securities laws, including and mainly under MiFID in European Union, we in Estonia basically are looking at three broad parameters of the instruments. And these are the following. First, legal terms and conditions. Those are the main ones. I mean, the legal terms and conditions of the instruments, how they fit into the, you know, the kind of hypothesis of legal norm. Second, of course, the technological limitations of you know, crypto asset, whether the legal terms reflect the technological reality or are they mirroring each other, so to say. And third, the economic purposes and uses of the instrument. So basically those three parameters, if I may call them so, are the main basis for qualification and policy decision that then we are going to take, whether one or another crypto asset is treated as a security under Estonian law. With NFTs, of course, the assumption and starting point is usually that they are non-fungible, and meaning that they are, as an assumption, they are not considered as securities under Estonian security law and also MiFID. But of course, it's a qualification case by case basis. So you cannot really generalize. Some of the things which are labeled as NFTs could be also treated as securities or security instruments. Now to your second question, my understanding as well is on the basis of current text of MiCA or draft MiCA is that this piece of legislation does not address NFTs in a way that it will bring them under, you know, the heavy regulation of that piece of legislation. But of course, we have also here parliamentarian, and I enjoyed the presentation because we needed the MiCA as well in Estonia. I mean, we are looking forward, and if the speed is up in parliament, that's great. But under current MiCA, NFTs are not in full scope. Now, what comes to concerns of supervisors, I mean, supervisors are always concerned. That's in a way our business to be concerned, and sometimes we are even too concerned. What comes to crypto assets as a broad feature and creature of financial world or world, I mean, my main concern at current juncture is investor protection, which means transparency of a product, how vulnerable it is to market abuse, for example, especially when compared to MiFID instruments, which are quite, I would say, heavily, some others would say properly regulated, but they are regulated. And I think we need the crypto assets, at least many classes of these should be equally regulated as well. What comes to crypto assets, my main concern or second main concern is collecting and laundering criminal proceeds and circumventing international financial sanctions with the help of crypto assets. So this is my maybe second concern in a row. And the third one is financial stability. It's currently small, but it's growing in a way, since the numbers and volumes are growing. So yeah, indeed. I mean, NFTs, which was your main interest or seemed to be main interest, I mean, they have quite limited use outside of the gaming world, outside of the kind of virtual worlds. I mean, they are quite heavily used in some of the games where the gamers are purchasing, so to say, digital art within the game environment. They are not that widely used outside of those virtual worlds. Maybe it will change in near future. You never know. I know that some authorities have taken gaming very seriously. I mean, at the beginning of this year, I could read from news reports that the Russian teenager, 16 years old teenager, was sentenced to 5 years in prison in Russia for allegedly planning to blow up a virtual FSB building, meaning that the Russian Federal Intelligence Service. So some of the authorities take even the virtual world maybe too seriously. So that is life. You know, this building was in Minecraft. Maybe some of you know Minecraft is this kind of virtual gaming environment. And then what comes to money laundering, you have to look at the purposes of regulations. I mean, while securities laws try to create transparency and avoid investments that are lemons, basically AML legislation is intended to deter criminal activity and stop bad actors by making them difficult to, convert criminal proceeds into assets in the real economy. So from that angle, I would conclude that NFTs fall or should fall under AML rules, and depending on the underlying asset, whether the underlying asset is falling under the scope of AML rules. So the default, what comes to NFTs, I would say what comes to AML rules is that, yes, indeed, they are falling under AML rules. So that's the three brief and short answers with context to my answers.
Thank you very much for this. And also thank you very much for bringing up the, let's say, the dimension, the Estonian dimension, because, of course, Estonia is very much ahead of many of us when it comes to digitalization and digital government. Now, I would like, if I may, to go back to Mercedes with a follow-up question. And I'll provide a little bit of context to my question to help Mercedes address it. Now, the European Law Institute published recently a report on the use of digital assets as security. And one of the premises of the report, and I was also involved in drafting that report, is that digital assets will often embody considerable economic value, and that one of the obvious ways to unlock the value and the potential that they hide is by using them as security for credit. Now, would you, as banking supervisor, look favorably at the use of digital assets as security for interbank credit? And would the use of such assets as collateral not have a significant contribution to make towards easing liquidity conditions and creating opportunities for growth? On to you, Mercedes.
Thank you very much for this very difficult question. I'm in favor of using crypto assets as a mean of mitigating credit risk. Okay, my answer is to be very, very prudent. I will try to explain or to classify the different kind of crypto assets in order to give you a general idea that what kind of crypto assets I would accept as collateral for a credit transaction. Last year, the Basel Committee launched a consultation paper about different kind of groups of crypto assets and also possible prudent treatment for them. My conclusion for this paper, for our discussion, was that there are two big groups of crypto assets. The first group that could include the so-called stable coins and also the tokenized traditional assets. For this group, Basel Committee proposed that we can use the normal legal framework, the prudential framework, to really to be applied for this kind of crypto assets, very similar to the traditional assets. But there is a second group that comprises the crypto assets that we can consider with greater risk, that in general are the crypto assets not operated by central bank, but that could be used as a medium of exchange for goods and services. And for this second group, the Basel Committee proposed to be subject to a weighting of 1,250%. If we are talking about mitigation, you can understand that really with this prudential treatment for this second group of assets, the Basel Committee in reality is proposing that this second group should not be considered eligible as collateral. Also, in this proposal, the Basel Committee established that a crypto asset to be eligible as a collateral should comply with two preconditions. One about liquidity. The crypto asset should be liquidable in a reasonable environment, market environment, in a very short period of time, also in downturn periods. And it's very, very, very important also the second condition, that is these crypto assets should be effective against third parties. In this sense, this is the two preconditions. We can see that in general, if we analyze most of the crypto assets we have in the market, they don't comply with these two previous conditions. As a result, we cannot consider them as eligible as collaterals. But if you were thinking about other kind of crypto assets, as for example, stable coins, as I have mentioned before, or tokenized traditional assets, yes, maybe they could be considered as collateral for a great transaction. A supervisor will expect that for this kind of assets that will be used as collateral, we have legal certainty about the ownership of the crypto asset, the location of the security provider, and its rights to encumber the crypto asset, the collateral value, and also if there are needed, the provisions you can use to cover or to sustain stable this value. The effectiveness against third parties, as I have said before, is essential. Also, to have a very good knowledge about the registration system in which this crypto asset will be registered as a collateral. And finally, all the mechanism of enforcement of this crypto asset in case of this crypto asset, sorry, the principal debt was not paid. Also, I will expect for the institutions that are using these crypto assets as collateral that they have effective risk strategies, and most important, very good risk management and risk measurement systems, complete involvement of the board of directors, and also a complete involvement of the top executive managers in order to be really conscious about the risks that the bank is facing using these crypto assets as collaterals. Also, I expect that the institution will deal with supervisors and regulators in a very open and cooperative way. And also that they develop a good infrastructure of disclosure their exposure of crypto assets, including all of these assets that will be used as collaterals. Summarizing, for a crypto asset to be considered a mitigation of credit risk, this crypto asset should reduce the risk of the principal debt that it means to cover or to really mitigate. I finish here. Thank you.
Thank you very much, Mercedes. Thank you very much for this comprehensive answer. And I turn very briefly, if I may, to Professor Dr. Wuermeling with the following question. Now, in their public statements around digital assets, supervisors tend to focus a lot on their risks, but they're much less vocal in terms of their benefits. So, in your opinion, is that because the risks very greatly outweigh the benefits? And could you very briefly walk us through any public interest benefits that you see in digital assets? Thank you.
Well, indeed, your observation about the inclining supervisors on the risk, we proved already today, even in this panel again. But this is part of our job description, to look at the risk, and the opportunities are usually quickly discovered by the market participants themselves. But indeed, we have to be aware that the changes of the financial system may bring about significant progress for in various areas, be it that market efficiency, be it access to finance, be it just simpler ways to conduct the transactions. Market participant, but also analytics can be more sophisticated, and even ourselves as central banks, we can use these technologies for supervisory processes, and we are ourselves discussing in the euro system to issue ourselves a digital asset, if you may say so, the digital euro. So altogether, I would say that digital assets may bring about a lot of advantages, not only for the market participants and for the providers, but also for financial stability. But one thing is very important, that the approaches or the attempts for regulation are coordinated internationally, because otherwise there will be arbitrage, there will be fragmentation, and a lot of the benefits of digital assets may not be come into a reality because of this divergence of regulation. So we may even need a Basel committee on digital assets beside the other committees of international standard setters.
Thank you very much for your response, which I think provides me also with a very good bridge for my follow-up question to Ondřej. So Ondřej, one of the things that you stressed in your 2020 report was the importance of international regulatory convergence and cross-border supervisory cooperation in the field of digital assets. And we've heard repeatedly today other members of the panel echo precisely the importance of convergence. Now, how realistic, in your view, is the prospect of convergence and cooperation in this field, given the, let's say, the different stage of development in the regulatory frameworks in different parts of the world, and the ongoing dialogue between different regulatory and supervisory bodies that try to deal with the emergence and growth of this sector?
Thank you for the question, and actually, indeed, I have taken note of the proposal of Professor Wuermeling about a possible Basel committee for crypto assets, because I think that is sort of a one form that the global cooperation can take. But you asked about how realistic the convergence is. I think we first need to see some of the regulatory frameworks to emerge. We already have in some jurisdictions some types of regulations in place. Places like Singapore with quite let's say, robust regulation already in place. We're working on our own legislation in the European Union. We know that authorities in the UK are discussing how to approach the crypto asset sector. The US executive order has been mentioned, and obviously the activities of the relevant agencies and I think are part of it as well. So I think to me it seems that it is inevitable that a sort of a cooperation among global jurisdictions on the issue of crypto assets is needed. And it is also because of the nature of crypto assets. And I think I would follow up to one of the statements that was made by earlier by the fellow panelists, that it is actually a very different type of asset that we are dealing here right now with today, with in principle a borderless nature. And it is then therefore very hard to make sure if the rules are set and put in place in one of the jurisdictions, that the operators or the stakeholders will not just use a different one in order to carry on with their activities. And I think this is the challenge that also we are all facing all across the globe. So in my view, it makes sense. It's logical. Obviously, it can take some time before it produces a tangible result. But as I mentioned earlier, in my view, it is inevitable. And if we look at some of the specific areas, such as money laundering, such as terrorism financing, the possible risks of circumvention of financial sanctions regimes, and other issues which are also by definition or need by definition a better international cooperation. I think we will just get to the point where we will need this discussion. And I know that, for example, from the European point of view, the European Commission is already having discussions with other relevant authorities from other jurisdictions. And I think if we manage to agree on a good regulatory framework, good set of rules in Europe, be it through MiCA or other relevant regulations in other relevant areas, then I think we can also into these international discussions bring our own contribution. And I also believe that if we are able to set those rules quick enough, those rules can be seen as a sort of a standard also by other relevant partners and other regulators or supervisors. So I believe there is a room for such a cooperation, and I think we should, at least as European Union, be very much active in this regard.
Thank you very much, Ondřej. And on this very, let's say, optimistic note, I am afraid we'll have to draw a line here. There would have been more points to discuss. I will not try to summarize the discussion, both because it's very difficult and because we don't really have the time. I would nonetheless like to thank you all very much for being here today.